The Pershing Square Capital Management Hedge Fund was founded in 2004 and is still managed by legendary investor Bill Ackman. A unique aspect of Pershing Square is that it is structured as a closed-end fund whose shares are publicly traded but managed like a hedge fund. Approximately $9.4 billion worth of public equity is held by Pershing Square, according to its most recent 13F filing. In a 3-year time frame from mid-February 2019 to mid-February 2022, investors following the company's 13F filings would have generated annualized total returns of 22.4%. Compare this to the S&P 500 ETF SPY, which generated annualized total returns of 18.17%. Hello everyone and welcome back to the Finance Guardian channel. In this video, we'll take a look at Bill Ackman's top 6 stock picks from the Pershing Square portfolio. Subscribe to our channel, click the bell beside it, and let's get this thing started. Before we dive into the Pershing Square's top 6 picks, let us first get to know the legendary man behind it. Pershing Square has been managed primarily by Bill Ackman since its inception, having initially funded the company with $54 million using his personal funds. After making many successful and creative investment plays, the billionaire hedge fund manager has gained legendary status in the investing community. The headline-grabbing bet that he placed last year turned $27 million into $2.6 billion. In his controversial bet that the coronavirus would tank the market, Ackman used credit protection on investment-grade and high-yield bond indexes. In the end, the trade turned out to be profitable during a period of decline for most portfolios. Wall Street journalists described Ackman's bet as the single best trade of all time because of its unique structure. Over the course of his career, Mr. Ackman has achieved many other notable achievements. Pershing Square acquired a 14.2% stake in Canadian Pacific Railway Limited (CP) in 2011. After a fierce battle with the existing board, Ackman succeeded in installing a new CEO and updating the company's business strategy. CP shares quadrupled in the next 3 years. A total of $2.6 billion of profit was generated by this successful investment for the activist hedge fund. Lastly, Ackman's bet on coronavirus generated a sizable return, but it's certainly not Pershing Square's first. Ackman revealed in 2009 that he achieved a 13-fold return on General Growth Properties, which was on the brink of bankruptcy during the Great Financial Crisis. After extending the company's $27.3 billion in debt for 7 years, the mall owner survived and eventually bought back Pershing Square's stake. This risky bet is now the second best of Ackman's investing career, translating $60 million into $1.6 billion, exceeding his initial expectations. Current portfolio holdings. While many hedge funds heavily diversify their portfolios by investing in multiple equities, Pershing Square's investing philosophy has always involved betting on a handful of high-conviction ideas. Currently, all $9.4 billion of its public equity holdings are invested in only 6 stocks. The current holdings of Pershing Square are quite similar to those in its previous 13F filing. The fund only sold a tiny portion of its stakes but significantly increased its Howard Hughes holdings. The following portfolio adjustments were also made. At number 6, Domino's Pizza Incorporated, DPZ. 5.74% of the international pizza giant is currently owned by Pershing Square. Stores continue to be added to the company's network, which currently numbers more than 17,800. In fact, 98% of these locations are franchised, so Domino's receives a steady stream of royalties that increase over time without having to finance these locations or bear operational risks. Today, a 5.5% royalty fee is charged for these locations. In this way, Domino's revenues are unaffected even if a store's margins are squeezed. As time passes, royalties grow along with new store openings, higher sales at the same location, and price increases. Although a number of challenges were encountered over the past year, revenue growth continued, demonstrating the company's operational resiliency and brand recognition. Shares of Domino's are currently trading at a forward P/E ratio of 29.5. This is a reasonable valuation multiple considering Domino's growth prospects and its great business model. Moreover, Domino's has been increasing its dividend every year since 2013, achieving a 3-year compound annual growth rate (CAGR) of 19.6%. Domino's is one of Pershing Square's holdings that execute strong share repurchases. A third of the company's shares have also been retired over the past 5 years, which is quite remarkable. Number 5. Howard Hughes Corporation, HHC. A total of 13.5% of Pershing's portfolio is allocated to Howard Hughes. Between 2019 and 2021, Mr. Ackman's position increased by 158%. Nearly 25% of HHC's shares are owned by Pershing Square, which significantly supports the Dallas-based property manager. Even though Mr. Ackman's picks usually prove to be highly successful investments, Howard Hughes has been struggling lately, failing to post consistent profits. Additionally, while the company has a substantial cash position of just over $1 billion, which is quite large given its $5 billion market cap, it also carries $4.46 billion in long-term debt. Number 4. Restaurant Brands International, QSR. Restaurant Brands represents just under 14.4% of the fund's holdings. A current stake of 7.63% in the company belongs to the fund. Despite shares losing more than half of their value during a coronavirus sell-off in March of 2020, Ackman's investment has been successful and the stock has regained much of its value from pre-COVID-19 levels. QSR's revenues grew further last year, while profitability remained at a high level. The stock currently trades at a forward P/E ratio of 18.2 with a yield of close to 4%. Number 3. Chipotle Mexican Grill, CMG. Chipotle accounts for around 18.3% of Pershing Square's equity holdings. Ackman has bought shares of the fast food chain since 2016, betting heavily on it. The company's shares have nearly quadrupled since, and Pershing Square still owns around 3.96% of its total shares. Chipotle is one of Pershing Square's most successful picks, currently trading at $1,489 per share, with an average estimated purchasing price of $386. Revenues have been increasing over the past year as the company experiences an extended growth phase. Although the pandemic negatively affected the restaurant industry, Chipotle benefited greatly from an increase in delivery orders. While Chipotle's growth slowed slightly last year, it remained strong at double-digit rates. Number 2. Hilton Worldwide Holdings, HLT. HLT, in which Mr. Ackman owns 4.5%, also reflects Pershing Square's strategy of holding large stakes in major companies. Ackman argues that, despite the negative impact of the pandemic on the hotel industry, which still continues, it should also force independent hotels to align themselves with global brands like Hilton, which will have a positive impact on its long-term growth prospects. A capital-light economic model and strong balance sheet further benefit the company. This quarter, the company boosted equity positions by less than 1%. Despite the initial disaster-like concerns during the COVID-19 outbreak, shares are currently trading near all-time highs, proving Mr. Ackman's prediction to be true. Currently, shares are trading for a forward P/E ratio of approximately 35.6. This is nevertheless an expanded valuation, so there may be a correction at some point. Also worth noting is that the company has around $1.43 billion in cash and equivalents in its war chest. This amount should allow Hilton to refuel growth as the industry recovers, while ensuring that Hilton doesn't face any solvency issues if recovery takes longer than expected. A 2% decrease in Pershing Square's stake in Hilton Worldwide International was recorded during the last quarter. Number 1. Lowe's, LOW. Pershing Square's largest investment, Lowe's, occupies about 1/5 of its public equity portfolio. Since 2018, Ackman has been investing in Lowe's since he hopes its market share will grow against Home Depot. As of Pershing Square's most recent Form 13 filing, the position was relatively unchanged. When Mr. Ackman built the position, he paid an average estimated price of around $95. With shares trading over $228, Lowe's has been a winning bet over the past couple of years. Since consumers have focused on home improvement during the past year, the company has posted rising revenues. It's surprising as working from home provided a one-time boost to the economy in 2020. This is why seeing sales increase further in 2021 is so impressive. The company generated nearly $96.3 billion in sales during the year, its highest ever. Lowe's net income margins have also been expanding to the company achieving higher economies of scale. The margins hit new all-time highs in the past year at 8.77%. Lowe's margins have not always been generous because it is a retailer, but at such sales volumes, its profits also reached record levels in 2021 with $8.42 billion in profits, its highest profit ever. In fact, Lowe's has increased its dividend for 59 consecutive years, making it a dividend king. Lowe's continues to return capital to its shareholders aggressively despite its mature profile. This past quarter, the company announced its 59th annual dividend hike, boosting the quarterly dividend by a massive 33.3% from 60 cents to 80 cents. This is the biggest jump in dividends over the past 12 years, much larger than its 10-year CAGR of 18.6%, with a comfortable payout ratio. The company has also repurchased its stock at a rapid rate, retiring more than half of its outstanding shares over the past 16 years. In this way, Pershing Square's stake will likely continue to grow, even if the fund does not increase its position further, as continuing buybacks gradually increase Pershing's ownership over time. Final thoughts. The public market listing of Pershing Square makes it unusual as a hedge fund that people can invest in. This company is helmed by renowned investor Bill Ackman and has outperformed the market thanks to its uniquely structured plays and high conviction ideas. The management's annual fee of 1.3%, previously 1.5%, in NAV and 16% incentive fee may seem steep, but the company's performance over the long run has been well worth it. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please remember to hit that like button. If you're new around here, subscribe to our channel, and on your way out, please do remember to click on that bell icon too so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.